Welcome to TradeTheMBI.com. This is John's report. It's for the 6th of April. Well, the softness that was below with magenta underneath and below 33, we pivoted lower, which accelerated that. But more critically, moving the white MBI closer to the red and significant spider right there, DOC, with shorts moving above as well as orange rising at the same time. Those are negative elements. Not quite seeing green under red, but it's close enough. And still within the normal range, nothing dramatic, supported off 76%. So continuation of that magenta decline is necessary, as well as the improvement of white over red, and that would signify a much stronger short position viewpoint. Jacob has been declining, pretty reasonable, nothing too out of the ordinary, or just maybe the market starting to wake up to some of the broader economic realities that exist out there. That said, I think we're still going to end up with a little bit of back and forth, because you have to get some catalyst that's going to really crystallize it for all that money that's got to be put into action. And it's got to go somewhere, and there's only two places here in bonds. And so the more frightened individuals become, the quicker they're going to move to treasuries, not because they're going to make them any money, but because at least they can park their money safely and pretend like they're getting a return, despite the fact it's being utterly eroded by inflation. It's never stopped anyone. We've talked about the disaster that is the Eurozone, and it's getting worse, because as Russia moves to cut off additional supplies, the EU adds to it by then deciding to ban coal. So just making the economic outlook for energy dismal for the Euro zone areas. And it's just hard to imagine why they're doing it, because all of this has been self-inflicted for the most part. Not the monetary crisis that was already developing in the EU prior to this, but you're about to break the 109 here, moving back towards the lows that we saw at the beginning of March. Probably should have never even spiked, but the Fed really doesn't want to let it get below that 108 range, because once you get down to the 105, 104, it's anybody's guess where it stops from there, because there's just no credibility left for the euro. Not a whole lot left for the dollar if the Russia continues to peg their currency to oil and gold. Really a death knell to the dollar, because it underpins oil that's priced in dollars to the ruble as well as the gold. And if they demand physical gold for payment, the paper market for gold is in a world of hurt. That's a whole separate issue. And if the dollar is less desired, who's going to own treasuries and cover the mounting debt, not to mention what's going to happen if the Fed actually decides to raise rates, because at $400 billion a year to service the debt, that's going to double if you start increasing interest rates a couple of percentage points, and that's going to cut into something, unless you're just going to run $3 and $4 trillion deficits, which I guess theoretically is possible. Who would have thought they'd be running $1 trillion deficits, but they've been doing that regularly. From a gold standpoint, no real impact at this particular stage. It just becomes interesting once the demand for physical gold, the paper market gold trade that mostly is what we would reflect here in the West from the continuous contract and stuff, really starts to degrade quite a bit, because then you get a bifurcation between what gold is traded at here and what the actual spot metal is traded at. Much the difference of gold coins in that trade higher than the spot price, simply because of they have to be created from a series of stampings and things like that. So it's a little bit different. Oil standpoint, was still over 100 for oil, so there's nothing to talk about there. That's just continued pressure for inflation broadly, not to mention just supply chain disruption, because at a certain point their cost to do certain things becomes so prohibitive you just don't do it, much like planting crops and things like that. You need lots of propane to dry the grain crops. I mean, there's just a whole lot that goes into it, but a lot of them require oil-based products as well as fertilizers and things like that. Again, all coming from places that you decided to block shipments from. So figure out how that's going to work. And so, of course, I've been predicting 125-ish for TLT, which is the 20-year Treasury. So that's a reflection that yields are rising, and that's what we expect to see. Whether the Fed likes it or not, the market is going to demand more of a return for that risk asset. Bitcoin having popped back up, created a couple of positive extremes in that pop right there, and the yellow right before it filled those back in. It's fairly clean. It's exactly what they did from before. The rise up, filled back, positive extreme, did exactly the same thing again. I like that. That's consistency. We don't object to consistency. Particularly pink bar readings from ETH, not bad at all. Similar, same kind of short setups develop, and then a much broader one coming after a few positive extremes. It began all the way at the peak of this one, that got filled. We had a secondary one that's right about there, that also got filled. So those were all doing just fine. It was these early ones right back here that needed work, and that's exactly what we retraced to the primary ones. Bingo, done, finished. Piece of cake. ES took its profits off of that one setup and then turned around too short in what was a short configuration. That's clean too. 5K standpoint, a little bit back and forth. We had a couple of little ups and then short signals, little paper pop up right there. Got weak with the white above it, and then once it broke down below that 33 and then hit 25, definitely into short range. And Pate never really looked back from there because even in the false pop, you were doing so high strikes of red within that, and the magenta having popped back above it can do that. That's a divergence that you can get within there. You were still reading pretty high white MBI over magenta on a lot of that, so it was really looking suspect, and then finally when it turned under the 33, clean to go, and then below 25, follow through. And boy, did it follow through. All the way towards the end of the day, and a little short cover right there, bringing it back up to the 50% range at this particular stage. Who knows, they may bring it back up a little bit more. This is hardly traumatic given that we're in 4,500 range instead of in the 3,800 range. So, all in all, not a big deal, but certainly reflective of what we're seeing from the indicators, and not nearly as negative as it should be given what the macro situation is. But we talked about why some of those situations, when you have so many people one-sided to that trade, it was easy pickings to force some short covering. And a lot of that's even been retail buyers jumping into a lot of these. And boy, they've never really experienced a situation where you don't buy the dip. So that'll be fun when that happens. That'll be some significant carnage, and that will actually play into an acceleration of a decline when that starts to flip over, because a lot of that's tied to people's personal wealth and more individuals that suffer those kind of setbacks, coupled with what's going to be supply disruptions, where even if you have the money to buy things, they just won't be available. You're going to get into some serious stop of the economy that will be much quicker than people expect, and that's unfortunately what we can look forward to. It's not that it isn't going to happen, it's just a matter of what the final breaking point is that starts that catalyst. So be vigilant, be ready for it, and prepare, because you need to have the right indicators to get you through it. As always though, trade well. Post any relevant details on Skype chat. Have a good one.